must not be reproduced or further distributed without our prior written permission. Trading leveraged products such as Forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved, taking into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. Please read the full risk disclosure. Okay, we're going to kick this off in a moment. Barak, it's great to see you here again. Hello to you as well. Right, so agenda for today will be a quick introduction as always, then what is this stochastic oscillator, then what is generating these stochastic signals, and then combining the stochastic oscillator or indicator with some other tools and indicators. And of course, at the very end, as always, we have the Q&A time, so definitely stay tuned for that. You can ask any question about trading in overall. You do not have to ask specifically questions about today's topic, okay? Just I will try to answer to all of your questions. If any of your questions remain unanswered for whatever reason, then the Hot Forex team will also be more than happy to help. So you would need to send an email to webinars@hfm.com in that case. Okay. So I am one of the senior traders here in Blue Sky Forex. We are an educational research and trading group. We teach various different strategies and also provide 24-hour trade support and analysis just to help you, retail FX traders, to make better and safer trading decisions. So right, jumping into the topic now. So what is this stochastic oscillator? So in its core, it is simply a momentum indicator that uses support and resistance levels. You'll get to see that as well in the next slide very shortly. But Dr. George Lane was the one who developed this indicator already in the late 50s. So it is a very, very old indicator, and hence it is also extremely widely used. The term stochastic refers to the point of a current price in relation to its price range over a period of time. Okay, now this method attempts to predict turning points by comparing the closing price of an asset to its price range. Okay, so price range is now taken into consideration here along with the closing price, and the resulting value of the stochastics calculation it's represented as the percentage K line, and is often considered as the fast or the signal line. Now there's also the slow line that is taken as a percentage D line, also plotted onto the stochastics indicator, and that is the next period moving average of that K line, which is the signal line. Okay. So there are two lines. One of them is the moving average of the signal line, and the other one is the actual signal line, what is based on the calculation of the stochastic oscillator. Okay. Now, as always, you don't really need to know the actual formula of the stochastic oscillator or any indicator by heart, because these calculations are done for you automatically by the trading platform program itself. And also the stochastic oscillator is freely available by default in the MetaTrader 4 application, which is the application that most of us here are using for trading, because most, if not all, of the current at least reputable FX brokers provide access to their own customized MetaTrader 4 program or MetaTrader 5. Okay, MetaTrader 4 is still very relevant because MetaTrader 4 has been in the game for a very, very long time already, and it's at least it has been for the majority of time has been more stable than the MetaTrader 5 application, and that is the reason why also most of the brokers have kept on using the MetaTrader 4 as their go-to option they will offer their customers. Okay, MetaTrader 5 when it came out was really, really unstable, and it had bugs in it. So, brokers and people didn't really flock over to the MetaTrader 5 when it came out, but it simply stuck to the MetaTrader 4. Okay. So how does the stochastic oscillator actually looks like? It is plotted here on this image at the bottom side of the page. You can see here it has two lines. The green line is the fast line or the signal line that we talked about before, and that is based on the actual calculation of the stochastics formula. The red line is simply the moving average of this green line over X periods. Okay, so the only part you really need to pay attention to would still be the signal line, which is the green one usually by default. But of course, you can always customize this around. So different people may have it with different colors, and especially if you download some kind of a custom-made version online, then it also may have different colors, and it even may have a bit of a different representation. It may even be a histogram. There are definitely custom-made versions out there like that. Now, I do always encourage people to try out custom-made versions of the actual baseline indicators. A lot of the times, the custom-made versions of the baseline indicators are actually better because they provide a bit more or enhanced insight about what the market is doing. Okay, the custom-made versions usually include something additional to actually either try to filter out some bad feedback that the indicator may give you in certain market conditions, for example. So that is the reason why I always encourage people to try them out. This same applies with the stochastics indicator. You can go ahead to the mql5.com website, which is the official website for the MetaTrader expert advisors and indicators and other plugins. So MQL5, MQL will be with letters, and number 5 is with a number. So mql5.com is the website, and there you can search the market for free of charge and paid baseline and custom-made indicators and expert advisors to try out. Now, please be advised that we'll get back to the stochastics in a moment, but as we're already talking about indicators and downloading, I just want to put a couple of things out there as a reminder. The expert advisors you can download from there. Please be advised that a lot of them are either designed to already generate losses on your trading account, or they are simply not good enough to work in a lot of different market conditions. Okay, and expert advisors, usually most of them are simply based on certain technical conditions. A lot of them do not consider with any market fundamentals, or they don't even check the news or have any news filtering in. So a lot of these expert advisors, they may work a little bit of time for you, but eventually they will fail miserably. A lot of them are based on some martingale system or some greed trading system, and then these both are really dangerous trading techniques. So I just wanted to mention it, that if you want to engage in any of the automated expert advisors there, then please definitely do so on a demo account at first, and be extremely careful because a lot of them simply don't work. Okay, so getting back to the stochastics indicator itself, there are different ways how you can utilize this indicator for trading. Now, before we go into any of these methods, I really need to reiterate that using any indicator completely alone and the feedback that it gives to simply trigger your trades or trigger signals and that you will follow blindly, it doesn't really work for an extended period of time. It may work out for you a couple of times, maybe for a week, maybe for a month, but longer term, it is definitely a recipe for disaster. The same way For example, if you go and use stochastics, then stochastics in overall is an overbought, oversold indicator. So it indicates levels where the price is in an overbought state and when it is in an oversold state. Okay, same as with an RSI. And now the RSI and the stochastics both have these certain thresholds. So when these thresholds of the stochastics value or the feedback that it gives, the number is crossed, then it is considered that the price is in an overbought or oversold state. Okay, for the relative strength index, which is the RSI, the very common default thresholds that are usually considered is 70 and 30. So if the RSI value shows you over 70, the price is in an overbought state. And if the RSI gives you a value below 30, then the price is in oversold state. Okay. Now the same goes for the stochastics, but the really common thresholds are slightly different. For the stochastics, the thresholds usually are considered to be 75 and 25, okay, and sometimes even 80 and 20, okay. So if you simply went short when the stochastics gave you a value of over 75, or if you went long when the stochastics gave you a value over below 25, then yes, it may work out for you a few times, but longer term, again, you cannot really use this indicator simply like that, just to trade the stochastic values, the feedback that it gives. It will fail. Okay, so keep that in mind. You should always combine this with some other indicator to filter out bad signals, or combine this with proper candlestick chart, candlestick pattern analysis, for example. If for that matter, you would really need to pay attention to candlestick reversal patterns, for example, continuation patterns, whatever indicates some exhaustion in the market, where the price may potentially reverse, and so on. Combining these things together, definitely you may eventually reach a profitable technique and profitable strategy. Okay. So the first method, or the first way, really simple, straightforward, how you could use the stochastics indicator would be to trade these breakouts. Now here on the chart, one second, let me just enable my cursor. So you should be seeing my cursor now. So on the chart here, you have these trend lines drawn onto the stochastics oscillator and also onto the price chart. Okay. Now, by drawing these trend lines below the price and above the price, you will have this kind of a channel created between these trend lines. Now you can see that this channel is getting smaller and smaller, so you have this price consolidating into a more narrower range. Okay, probably you have some news event that is coming up, and that is the reason why people are staying out of the market, hence causing this kind of a price consolidation. The price is slowing down. You have less market participants, volume and the volatility is dying down just before the news event, because people are staying out of the market. And then you have trend lines drawn onto the stochastics, also, at the bottom, below the stochastics and also above the stochastics. Again, creating this kind of a channel. And here you can also see that this channel, or this area between these trend lines, is getting smaller and smaller, replicating the same what's happening on the market. Okay, and that is a good thing, because we're not searching for divergences, and we get to divergences in a moment as well. So the breakout trading in this kind of situation, and when you are witnessing this kind of consolidation happening, then at one point the price will break out. Okay, this consolidation cannot last forever. It cannot go into a completely thin line or simply a straight line or a dash sign here forever, right? It doesn't do that. It eventually does break out from such kind of a small, less volatile movement, and usually it does so when the actual news event is eventually released, right? So the news numbers are released, what people are waiting for, and they are then, analyzing the numbers that are released and then making their decision. Probably you will have a battle between the bulls and the bears right after the news event, and the market, may become really hectic, fluctuating really rapidly up and down. But eventually one side will be victorious, and that will be the side driving the price in their direction. And in this occasion, as you can see, right after the consolidation, you start having, these candles breaking out from this current range. So that is what is causing, here is somewhere where the news event hits, right? And the price will then break out from this consolidation range and start trending in one direction. So here the bulls obviously won the battle. The candles started closing outside of the previously established consolidation range here, and that's the side where we will be taking our trade. Okay, and the trade can be taken as soon as the first candle clearly closes outside of this range here, and then you can trade upwards. Of course, the stochastics should be doing the same thing. As soon as the stochastics crosses the signal line, crosses the actual smoothed out average here, and goes out of this consolidation range as well. So if you have the price doing this thing and also the stochastic showing exactly the same thing, breaking out of this consolidation range, that would be your breakout trading opportunity with the Stochastic Oscillator. Okay, this kind of breakouts from such kind of consolidation formation is not only observable with Stochastic Oscillator. There are other indicators as well where you can verify this consolidation and the breakout happening on the chart as well. Okay, so that would be been a pretty good trade going upwards here. Okay, so I'm combining price action and the Stochastic Oscillator together. We can get a breakout trading opportunity for sure. The next point is a bit controversial because a lot of people find it a bit weird to use an overbought oversold indicator like that, but I hope you understand the reason why it can be used like this in a moment. So an overbought oversold indicator can actually be used for trend trading as well. Okay, I have one user saying that there is no sound, although the GoToWebinar module is telling me the opposite. The sound seems to be coming through. So can somebody just confirm that they are properly listening, properly hearing the voice, the audio? Okay. Thank you, Talitha. Zoran, thank you. Seems to be audio is fine. So Barak, I hope you will get to see the recording then later on. Perfect. Thanks for the confirmation. Right, we can continue now. Right, so an overbought oversold indicator used for trend trading is a thing. You can do that, but you have to obviously be really, really careful. There are a couple of things that you will certainly need to keep in mind. Now, in very heavily trending scenarios, in very heavily trending markets, you may witness the overbought oversold indicators also being lingering around in one extremity for extensive amount of times. So like you see here in the image, the stochastics can be in an overbought oversold state for quite a bit of time without it even leaving this threshold. Okay, so the overbought oversold indicators can linger around, rapidly going up and down within that overbought or oversold threshold. And if it is doing that, then there are a couple of things that you will need to pay attention to. First of all, if you have witnessed that during the previous impulse wave, meaning impulse waves are the price movement waves that move in the direction of the currently established trend, and the corrective waves are the price movement waves that go against the currently established trend. Okay, and that's where the Elliott wave theory comes into play. So it's really useful to know that, although not required to be ultimately profitable or successful, but it's good to know. So I highly recommend taking a look into that. So Elliott wave theory, right? Regarding this trend following technique, if you have witnessed that during previous impulse wave, the overbought oversold indicator like the RSI or stochastics in this case has been already kind of locked in the overbought or oversold threshold without leaving it for the whole duration of this impulse wave, like here in this case, then the next time it happens, during the next impulse wave, as soon as the indicator comes back into the overbought oversold threshold and stays there for 1 or 2 candles, then you would have a trading opportunity. Okay, so like you see here, here on the very left side, you have just one corrective wave. Maybe you had a downwards trend and now it reversed. That's totally fine, doesn't matter. Okay, and now you have a green bullish momentum into this next impulse wave, and the stochastics really quickly goes into the overbought threshold, overbought area. Okay, and it does stay here already, and you have these additional few strong bullish candles with little wicks, and at the end of the second, maybe the third candle here, that would already be your trade entry, because here you have on this third candle, the stochastic is really giving a heavy overbought value. Okay, but yeah, that would be actually the very first impulse wave in this overbought territory. That's not the one that you will actually be trading. You will be trading the second one, but you are witnessing that the first one is really clearly in the bullish threshold. Okay, now here you can clearly see you have some sideways movement, just a little bit of retracement here as well, just a little bit of correction. And during this correction, you already see that the stochastics does come out of this overbought territory. As soon as it goes back into the overbought territory, you see that the next impulse wave is starting, and already on the third candle, again after this one closes, you have this remaining in the overbought territory. You could go for a bullish trade and trade along with the direction of the trend until the stochastics leaves this overbought territory once again. Okay, your entry will be at the second or third candle when the stochastic is already in the overbought territory, and you can exit the trade when it comes out of it again. But now you really need to pay attention to what are the news events released in the market. Okay, if you don't have anything of actually backing up this kind of a price strong trending price movement, then trading along with the trend with an overbought or oversold indicator can definitely be very, very risky. Okay, if you're using this indicator to follow the trend, then you must have something really backing up the price movements. So there must be some kind of a news event, a heavy impact news event that is driving the asset price higher, that gives this the bullish strength. Okay, so that would be the second method you can utilize when trading with the stochastics. The third method would be to use it exactly how it was basically designed to be used. Okay, and that would be the trend reversal. And that is exactly the opposite of the trend following method. Okay, now the stochastic is an overbought, oversold indicator, and that means that, you know, if the price is in an overbought state, it does have considerably higher chances of actually facing an exhaustion and then a reversal. Okay, or at least a considerable retracement during a trend. So if the stochastic is in a threshold here up, so the upper threshold, meaning in an overbought area, then you would generally, based on the overbought, oversold principle, you would be biased towards making sell trades, right? Because the price is in an overbought state and it does have increased chances of reversing and going downwards. So utilizing the stochastic indicator purely for that purpose, again, alone doesn't work for sure. Might work out a couple of times, but longer term, it's a recipe for disaster. But if you combine this principle into another strategy that you already have been using and actually is working, and you're trying to enhance that strategy by adding an overbought, oversold indicator to potentially filter out some signals, that would be the perfect usage case for this trend reversal idea. Okay, so the principle again is that when the stochastics reaches the overbought territory, which is the upper side here, then you would be looking for a sell trade or initiating a sell trade based on some additional conditions, of course. Or when the stochastic reaches the oversold territory, which is the bottom side of this range of the indicator values, then you would be looking for buy trades. Okay, but again, approaching this by simply following the overbought, oversold statuses of the overbought, oversold indicators doesn't really work out for a long time. So I advise you to utilize these overbought, oversold statuses simply to filter out some signals in already established strategy. Okay, so that is the third method how to use this stochastics oscillator. And the fourth method is divergences. Divergence is something that I mentioned already earlier. Now, divergence basically means that if the price of the asset is showing you one thing, but the indicator is showing you the opposite. So for example here, if you use trend lines to connect the lower lows of the price, you can see the trend line is sloping downwards. Okay, here the image is a bit small, but I sincerely hope you can actually see it properly. So if you connect the lower lows of the price when it is painting on the chart, then you will get a trend line that is sloping downwards, like here. Okay, so the very lowest low is the last point used, and the point previous to that is the first point used. And onto the same stage, in the actual indicator, you also are connecting the low points together. But here you will have not a lower low, but here you have a higher low. Okay, so in this case, the trend line is actually sloping upwards. So again, on the price chart, you have a trend line sloping downwards, so it's going downwards. And on the stochastics, you have a trend line that is sloping upwards. So you have a divergence between the price and the actual indicator. So these kind of divergences are actually a very, very strong sign that a reversal is coming up sometime soon. The bad thing about divergences is that it will never tell you exactly when the reversal is coming up. If it did so, then probably all of us would be very rich by now by trading this kind of reversals, right? So divergences don't tell you when it's happening, but it's telling you that it's very, very likely to happen sometime soon. So divergences do give you a trading opportunity by letting you know that you should look out for an upcoming reversal that should be happening very, very, very soon. Okay, and in that sense, divergences are a very, very strong tool and very, very reliable. I do personally love the divergences. You will find a lot of them on the price chart and between the indicator and the price. So there will definitely be a lot of situations or a lot of opportunities for reversal trading when you do spot a divergence between the indicator and the price. The easiest divergences are spotted between the stochastics and the price and the RSI and the price, because basically they are a single liner indicators, so single line indicators. Stochastics also having a single line that is actually representing the signal or the calculation that is giving you. The RSI is also giving you one single line, so it's really easy to spot such kind of a divergences between those indicators. Okay, so certainly something to keep an eye out for if you already are used to spotting such kind of divergences on the price chart. Then with stochastics you can also observe that. Okay, so really straightforward. Now combining stochastics together with some other indicators. Now we already talked about not to use a single indicator alone to trigger your trades, but combine this with some other indicators to filter out some bad signals potentially, or just mold this indicator into already an established strategy that already is using some other predetermined conditions to initiate a trade. Maybe stochastics will be helping you to filter out some potentially bad trades. Why not, right? So just to improve the quality of trades and give you a bit more meaningful signals, you can use stochastics for that, along with some other technical indicators. And the first indicator, the very most simple indicators out there at all, is the moving averages. Moving averages can always be a very good companion to your trading. It doesn't matter what kind of strategy you are using, doesn't matter what type of trader you are. But of course, if you are a day trader or a higher time frame trader, if you're a position trader, you're aiming for those large pip gains, then moving average will probably prove a bit more useful than if you were a scalper. Okay, but still, moving average will give you a very simple representation of the past moving averages of the actual asset price. Okay, so it's a simple indicator, but if you add it onto your chart and you set it to a high period like 100 or 200, it will really give you a good insight of where the generally moving trend is going at the moment. Okay, and in a very simplistic method, you can simply look for long trades if the price is trending upwards, and simply completely ignore the short trades, sell trades, and then vice versa. So you can even use moving averages to filter out trade direction very easily. Okay, and a lot of people are actually doing that. And while it may filter out a lot of opposite directional trades, still trading along with the trend is really the best way to trade, right? Because that's where the profit, the biggest profits are. Just letting the trade run. If you are in the right direction, and then you can reap up some, good money. Especially if you're a longer-term trader, if you're using a trading stop. Okay, trading stop dynamically locks in more and more profits. So for longer-term traders, trailing stop is really kind of the magic tool to really create great profits in certain situations. Okay, so moving averages is one of the most simple indicators that you can combine the stochastic oscillator together with. Then you have obviously price formations, candlestick patterns, you have shooting stars, you have dojis, you have all of these different kinds of candlestick patterns or formations that advise you if the price is facing some exhaustion right now, or giving you a heads up when a reversal may be happening, or giving you insight if you're dealing with a good bullish or bearish, increasing bullish or bearish momentum, for example. So all of these kind of different price formations, like wedges, triangles, rectangle formations, you can combine together with stochastics, and then trade those formations, and just using stochastics to help along with it. Okay, and especially utilizing it for these kind of breakout formations like we showed before. Okay, and of course, coming back to the trend lines are especially important if you want to spot and identify divergences, and of course when trading trend reversals as well. So trend lines are always and have been and will be very, very useful in all kinds of trading, not only to spot divergences, but for overall price chart analysis as well. Don't hesitate to draw these horizontal, vertical, or diagonal lines onto your chart. You can put them as many as you want, because these lines are temporary. Usually you can really easily remove those lines to make sure you don't clutter up the workspace. But in the moment, for different kinds of purposes, you can use how many trend lines you really need in order to properly conduct your chart pattern analysis adequately. So don't hesitate to use trend lines, but keep in mind to delete them afterwards, after you have done your analysis, because you may want to come back to that part of the price action to reanalyze that for whatever other purpose, to determine SR support resistance lines for the future price movements, for example, and so on. So the trend lines are something that potentially could or should be removed from the chart afterwards, and it's really easy to do so. They are temporary. So keep your chart clean. If you start adding too many indicators on the chart, that will be worse, right? Because that will clutter up your workspace and you cannot really properly analyze the price chart anymore. Stochastics is one of the indicators that is added on below the actual price chart. It's not added onto the price. So it will take away the area for the actual price. The price itself is the most important indicator of them all. That is what you are trading, okay? That is what you should be analyzing. Stochastics and indicators like that will take away that space. If you added an RSI here as well, for example, then the price chart area would go up even further. So that would be the line where the indicators would stop, right? So you have less space to actually analyze the price. So that means you shouldn't really be adding too many indicators onto your price chart, just to keep it tidy and allow yourself the best conditions to actually analyze what is important, okay, which is the price. So just to conclude, do not overclutter your workspace. Now, these are a couple of ways how you can utilize the stochastics indicator. There's really not much more to it, because it is a straightforward indicator. It's an easy one. It is a simple overbought oversold indicator. So Definitely a lot of different ways how to use it, but here are a couple of most straightforward ones. Okay. Now, before we end this webinar, let's just go through a couple of currency trading dangers quickly. First of all, try to refrain from utilizing any automated systems that place trades on behalf of you, because a lot of them are designed to generate losses on a trading account, or they simply cannot perform in different market conditions. So in one market condition, the expert advisor or the bot may actually perform really well. But in other market conditions, and when the market slightly changes, then the expert advisor or the bot will fail severely. And usually when it fails, it will actually eat up not only your profits, but your whole account. Okay, so please be careful when you try them out. If you want to try them out, then please do so on a demo account. And if you witness your demo account balance increasing steadily without large drawdowns over an extensive amount of time, and by extensive amount of time, I consider for testing period a 6-month period forward testing for an expert advisor to even slightly consider it, whether it is capable of performing or not. Before 6 months, I do not consider any strategy to be profitable or not, because even the profitability can come in waves, and not even monthly waves. It can come in yearly waves. You may have a couple of years of really good profits, but for the next 5 years instead, it will actually fail miserably. So even a year time wouldn't actually be sufficient to, with 100% confidence, state that the expert advisor or an automated system is successful. Even a year is not enough. Now, this comes from experience, but if you span your testing period to be for each and every EA to be a year or more, and then you will be an old man before you come to any conclusions, right? So half a year is the minimum that I'm considering an expert advisor testing period on the live market. Okay. The second point I want to make, that only 5% of retail FX traders are successful long term. And the reason behind this is our own human brains, our own bodies. And this is because of our faulty risk and money management. Okay. And I say faulty risk and money management is because our own emotions. And what are emotions? Emotions are triggered by certain chemical reactions in our body due to some chemical substances or hormones, for example, right? So emotions are chemical reactions in our body. And for example, if you are on a winning streak, let's say you win a couple of trades in a row, you're really happy, feel right on, I'm really doing it. You will have some dopamine and adrenaline released in your body, and these chemicals make you, grant you this happy feeling. And of course, we as humans, we become addicted to that kind of a happy feeling, okay? Because happy feels good, right? Happy is a good feeling. And we get addicted to that, and we want to feel it more. And in such kind of a situation, if you are already in this happy feeling and you want to feel more of this, you know what you did to generate this happy feeling. You won some trades. And now as you want to generate more of this happy feeling, you are going to generate more of such kind of trades. At least you think that you're going to create more such kind of trades. It doesn't mean that the new trade you are initiating will also be successful. And by you being in that kind of euphoria with your happy feeling, and you want to make more of it, you actually stop analyzing the price charts properly or enough or adequately enough, and then you will start making mistakes. You will then start losing some trades, and this happy feeling will get replaced with a sad feeling or frustrated feeling. And now your body is releasing different kinds of chemicals and hormones. And eventually you become a chemical cocktail, so to put, right? And now as you are in such kind of a situation, you become an animalistic trader. You really stop thinking clearly. And furthermore, you start making more mistakes, and even more severe mistakes that leads to more losses. And now you already are in revenge trading mode, because you have lost either some of the profits you made thus far, or even went into a minus already, and now you're revenging the market to try to win back some of the money that they took, right? And that already is a very bad situation where you can really easily destroy your account. And that is the reason why only 5% of retail FX traders make money in the long term. Now, to actually help you with that, there are 2 rules that we here follow in our team, and we are extremely strict with those. Now, these rules are not meant to be broken, because if you start breaking these rules, then you will keep continuing. You will continue to break those rules, and then there's really no point to have them in place at all. Okay? Now, these 2 rules that we follow in our team are the 1% rule and the 5% rule. Now, I do talk about these rules really often in our webinars, and the reason behind this is because they are extremely important. So the 1% rule goes as follows. No single trade should be able to cause you more losses than 1% of your total account balance. Okay, once again, no single trade should be able to cause you more losses than 1% of your total account balance. Now, on the internet, you probably will see that percentage be also 2%, which is also fine. Don't get me wrong, but we lowered it to 1% to trade extra safe, okay? Because that will allow us to remain in the game for extended periods of time, okay? And the second rule is that if during one single trading session you will lose 5% of your total account balance, you will shut down your tools and walk away. Okay, so once again, if during one single trading session you lose 5% of your total account balance, you will simply shut down your tools and walk away, and you will accept the loss. Because if you don't accept it and if you go on, you will cause more damage to your account. Maybe the market isn't really favoring your strategy at the moment. Maybe the market conditions are not just right, okay? And that happens. It's actually totally fine. You will have market fluctuating really often, and the market conditions can even change intraday. Okay, so you have to accept it, and there's really no way around it. If you have multiple different strategies in place for different market conditions, then sure, go ahead and switch your strategy around and see if the other strategy works better. But you cannot do that, even though you cannot do that if you are already past the 5% account loss mark. Okay, you then cannot really switch around your strategy and then start experimenting again with another 5%, because ultimately that would be breaking the rule, right? So you can do that when you haven't yet reached the 5% mark. Anyways, these are the 2 rules, and if you do follow them extremely strictly, then you will have higher chances of becoming a longer-term successful trader. And the final point, last but not least, is that only 5% of retail FX traders, 5% of signal services and signal rooms are actually legitimate. So before you actually put your money in them, please ask for a proper performance record and audit trail. And better yet, if you can ask for any feedback from previous or current users, longer-term users, and see if they have been able to grow their account capital steadily over longer periods of time without large drawdowns. And if so, then you can decide if you want to set it up on a demo account at first. And if you witness the same thing on your demo account, then you can think about setting it up on live, right? And if you set it up on live account, please use low lot sizes to trade as safely as possible. Okay, so that is it for today's topic. I hope I was able to give you an introduction to the stochastics indicator. It is still fairly simple, straightforward indicator. Don't use it alone completely to trade on its own. Indicators cannot be used like that. It doesn't work out for you longer term. Combine this with some strategy or some other indicators for maximum efficiency. Okay, so now it's time for questions. Let me just open up the questions section. I'll take as many as I can. If any of the questions remain unanswered, again, please don't hesitate to send an email to webinars@hfm.com, and they will be more than happy to answer to your questions as well. Okay. Seth is asking, does it also apply for trading the news? I do apologize, I'm not sure exactly on what slide I was or what I was explaining when you were asking this question. It was about the 31-minute mark. Probably I was somewhere around any of these slides. Anyways, please just let me know what exactly do you mean, and I will come back to that question in a moment. Noah is asking how to identify the reversal point while in overbought or oversold territory. Okay, that actually is a really, really good question. I was explaining before that you can use the stochastics to indicate you the overbought, oversold areas and territory, and that should give you an idea that the price would potentially reverse soon, right? Because it is currently overbought or oversold. Okay, and I explained that you can't really know 100% ever, even with a divergence or when the overbought oversold indicator is giving you an overbought oversold value at the moment. You can't really know when the actual reversal is coming up, right? We know that it is coming potentially very, very soon, but when it exactly is coming, we can never know, unless you do a proper price chart analysis. You do have these candlestick formations that give you a hint that the price is facing an exhaustion, or the price's movements are slowing down. And for example, you have the most popular, this exhaustion candle that in most cases signals price exhaustion, is a doji star. Okay, a doji candle is a candle that has almost no body, so it opens and closes almost at the same price level. But during its time when it was still active, it had considerable fluctuations up and down. A perfect doji is where the up and down fluctuations weren't too large either, so it looks like a plus sign. That would be like a perfect doji star. But there are different doji versions out there, some of them having a longer wicks on the bottom and at the top, for example. So doji star still in most cases signals exhaustion in the market and that the potential reversal is coming up. Now, combining that together, for example, with the overbought or oversold feedback that an overbought oversold indicator gives you, that would be a second confirmation that now might be the point where the price is about to reverse. Okay, so you can use candlestick patterns for that reason. You can use some other overbought oversold indicators to put on the side, but at the same time we don't usually recommend adding multiple of the same type of indicator onto your price chart, because it will simply show basically the same thing, but just take away your chart space. Okay, so main thing would be to look out for would be the candlestick patterns to spot the actual moment of a reversal, if you have, or when you have spotted a divergence, or when you are witnessing an extreme overbought oversold value in an overbought oversold indicator. Okay, I hope that answered your question. Guys, okay, Seth is also mentioning maximum number of indicators. I don't think that's a question, or if it is a question about maximum number of indicators, then the maximum number of indicators you should actually add onto your chart would be 3 or 4. I would go with a maximum 2 indicators that are painted separately of the actual price chart, like the stochastics or the RSI or MACD. These are indicators that are added above or below the actual price chart. And then 1 or 2 indicators that that are added onto the price chart, like the Bollinger Bands or the moving average, for example. Now, this way, you will not really clutter up your workspace too much. Going with 4 indicators maximum will also allow you to manually identify and draw a horizontal support resistance line onto your chart without cluttering up the workspace too much. It will also allow you to draw some trend lines here and there without cluttering up your workspace too much. So going with 3 or 4 indicators maximum would be kind of the best way, I would say. Okay, 1 second, please. Barack, again, thanks for the good words. It has been my pleasure. Loretta is saying, it seems to me that lowering the leverage of my account put me closer to as the margin required grows higher, which is safer in a way. Am I right? Yes, you are completely right. In any way possible, we all also here in our team recommend to trade without any leverage at all, if possible. But I do know that for most retail traders, trading without any leverage isn't really an option because they don't have significant capital available to actually trade without the leverage. A lot of people cannot do a deposit more than $5,000, or a lot of times $5,000 already is a bit too much for them. They don't have this free money to actually invest and trade with it, which is totally fine, understandable. The pockets have different depth for different people. Some people do have like 100,000 lying around and they want to invest that, for example, or do something with that. And there are people like that as well. On retail trader field as well. So trading without leverage is always preferable, or having it as small as possible. That will actually still allow you to initiate trades, at least have like 2-3 trades open at least. You should go for that kind of leverage level. Leverage is basically anyone who has tried to open an account will be presented with a choice, how much leverage they want to have on their account. And I'm quite sure most of you have already researched or understood what that is. So I'm not going to dive, deep into that. But leverage is basically how much money you borrow from the broker to initiate a bigger trade than you with your balance actually could. So that means that your profits will be greater, but also your losses will be greater. So it's a double-edged sword, like everybody says. And the margin call will be when the broker basically stops out of your trade because you simply cannot remain solvent with your own funds or your own balance that you have deposited into the broker's account. So they're going to stop you out of the trade when the trade goes against your direction. Okay, Seth now has clarified a bit. The overbought and oversold stochastic signals, do they apply to trading the news? Okay, so you are talking about exactly the slide that I'm having here in front of me, I presume. So when the stochastic gives you an extreme overbought or oversold state, and if that is happening during news. Now, this is the method that you would be applying in such kind of case. That would be the trend following method. Okay. Now, the trend following method is when the stochastic is giving you an extreme overbought or oversold value by crossing the threshold into that threshold, right? And you have something backing up the movement. So you have some high impact news actually released on the market that is making the price trend in one direction. Okay. So in one impulse wave, with the first impulse wave, you see that the stochastic or whatever overbought oversold indicator you're using, it sticks to the overbought threshold. Now during a pullback, obviously it comes out of this threshold, and the next time during the next impulse wave it goes back into the overbought threshold. Then would be the time to enter the trade after the second or third candle actually closes and the stochastic or any overbought oversold indicator would be still in the overbought threshold. Okay, then you would be trading along with the trend if there is news event actually backing up the movement. If there is not, then I wouldn't go with the trend following method like shown here. Okay, so trading the news would be when utilizing this trend following method. But if you have a news event just released, you will anyways witness the market crazily fluctuating up and down. You have the battle between the buyers and the sellers. So there you cannot really trade anyways, because the direction hasn't really been fought out for yet. Okay, I hope that answered your question. Okay, Seth tunes in from Ghana today. Nice to have you here. Gregory is asking, is the stochastics effective in smaller time frames? For sure. Every indicator can be effective in smaller time frame charts like 15-minute charts and 5-minute charts if used correctly. But you always have to keep in mind that the smaller time frame chart you go to, the more price noise will be factored into the actual candlesticks and the indicator readings, the feedback that it gives you. So they will become significantly more inaccurate. So always keep in mind, if you zoom into the chart, you will see much more noise, and whatever indication, whatever analysis you're doing will become such more ineffective. Okay. But if used correctly, of course, they can still be used, and they're still effective in a way, and they will give you a valuable feedback to a certain degree. Loretta is saying that she has the 1 to 10 leverage level, which is actually really good. I expected you to have more. I expected you to have like 1 to 50 or 1 to 100 or something like that. That is usually really common nowadays among retail traders. But 1 to 10 is really, really good, actually. And really nice that you are able to, trade with your account with that leverage. That's really nice to see. Loretta is saying, I missed the first part of your explanation. Which part? You mean the leverage part? Or the leverage part? Sure. The leverage that you have right now, the 1 to 10, is actually a really, really good leverage level for retail trading. I thought you would be having a higher leverage, like 1 to 50, 1 to 100, for example, because that is extremely common nowadays among retail traders. So 1 to 10 is really good. Okay, 1 to 10 is really nice leverage level if you can adequately still, initiate trades, and you will not be facing margin calls really often. So then, yeah, for sure, stick to that. Don't increase it if possible. And if possible, at one point, if your balance is high enough, you can even lower it. That would be even better. Okay, Lorenzo said that the part that the required margin going higher. Sure, look, if you lower your leverage, right, then basically you are borrowing less money from the broker, okay? And then that means that you have to have higher balance to actually be able to initiate, trades with that are so large, okay? So that is the reason why your balance, your money on your account needs to go higher. Needs to be higher for you to actually initiate such trades. If you have a higher leverage, then you are able to borrow more money from the broker, and you don't have to have so much money available yourself to actually initiate those trades. Gregory is asking, and I think that will be the last question for today because we're way past the 1 hour mark. So the last question for today that I will take will be, do we use the default settings for the stochastics and the moving average, or are there recommended settings? That's a great question. And the default settings actually work for most cases, for most indicators, really well. Okay, and the default settings for the stochastics will be sufficient for you to try out trading with stochastics. Obviously, always experiment with different period settings, with different settings, other settings that different indicators may have, and see what actually works best in your strategy. Okay, so I highly recommend or encourage people to test out different settings, but the default ones are really good to start with. Okay, so this is it for today's topic about the stochastics indicator. Thanks for joining. It was really nice to see so many of you here today for such an easy and straightforward webinar. Actually was really surprising. The stochastics indicator, really widely used. I highly recommend looking into that as well yourself. And from my side, thank you for attending. Please do trade safe, stay safe, and good luck, everybody. And we will see you again next week. Take care and have a lovely rest of the day.